REC is doing in trade today, but we have the management of REC. The stock has been on a tear at least over the last 5 days. Stock is up 22%, and over the last 1 year, it's up 4x. Over the last 2 years, the stock is up nearly 5.5 plus x. So it's been a multi-bagger of sorts across time periods, and it's been a very solid performance from Q4 as well from REC. To give us more perspective as well as to understand what we can expect going forward, we have with us Mr. Vivek Kumar Dewangan, who is the Chairman and Managing Director at REC Limited. Firstly, welcome and pleasure having you here, sir.
Thank you, Harsh.
Sir, again, first off, congratulations on a very strong quarter yet again. You've beaten what street estimates had really pegged with regard to your Q4 numbers. I want to focus in on that, especially with regard to recoveries, because that's the real number which has given you a leg up in terms of what estimates were versus what you delivered. Talk to us about the write-backs as well as the recoveries which are coming through with regard to FY24 and what one can expect for FY25 with regard to this number.
FY24, we got recoveries of to the tune of about 750 crore. And going forward for FY25, as we are planning to resolve all the stressed assets, we are expecting write back to the tune of about 1,500 to 2,000 crore.
Understood. Write back of 1,500 to 2,000 crore. This is net of any loan losses which you will incur as part of this recovery process, is what I assume.
Yeah, that's true, because some of the assets are heading towards liquidation. For that, we already made 100% provisioning, and some of the assets, the operating asset for which we have made provisioning about 70%, we are likely to get very good returns from that, because our haircut has been limited only about 20 to 30%, and we are expecting better resolution, because KSK, Mahanadi, Sinnar, Nasik plant, Hiranmaye, they are going to give us better returns.
Understood. For viewer context, 14,000 crore is the profit after tax for FY24. You're expecting 15% of that number just in terms of recoveries for FY25. I want to try and bring in context with regard to growth as well, because you were expecting to double your balance sheet in the next 4 years. How confident are you of that number?
We are quite confident, actually. In 22-23, we started with a loan book of 3,85,000. At the end of 22-23, it rose to about 4,35,000. And in FY24, our loan book has increased to 5,09,000 crore. So there has been a growth of 13% into 22-23, and FY24 we saw growth of 17%. We are expecting this growth trajectory will be able to maintain, and 15 to 20% growth every year we are expecting. That's why we are targeting to double our asset under management to about 10 lakh crore by the year 2030. But if this growth trajectory of 17% continues, then perhaps we may achieve this asset under management of 10 lakh crore by the year 2029 itself.
Okay, so before I go to 2028 or 29 FY, which is roughly the trajectory which you're currently taking with regard to doubling loan book, I want to first talk about the levers with which will probably help you get there. You're getting into infra financing. You are getting into financing of renewable energy, both on the individual side as well, rooftop solar and the like, as well as renewable financing in terms of renewable energy financing in terms of the industry and the scale which the industry requires in terms of financing. What are these levers like in terms of growth? How will the book shape up with regard to these 2-3 new levers, as you would call it?
Let me tell you that our renewable energy portfolio is at around 35,000 crore. We are expecting a tenfold increase in our renewable energy portfolio to say about 3 lakh crore by the end of 2030. With regard to non-power infrastructure logistics, our loan book is about 50,000 crore, and we are anticipating that it will see fourfold growth by the year 2030. Will reach about 2 lakh crore by the end of 2030 for the non-power infrastructure logistics. Plus, one more additional component has been added, that Central Electricity Authority and Ministry of Power have worked out the base load requirement for the country, and country will still require coal-based thermal power plant to the tune of about 94 gigawatt capacity by the year 2032. That will also give us additional lever for increasing our loan book.
Understood. So just the rough math that I'm doing, basis what you've just suggested, just these two new verticals will probably add roughly 4 lakh crore to your current balance sheet. So are you expecting prepayments, repayments to therefore in some form dampen growth on the thermal side of things, or you're expecting thermal also the demand to be quite robust? So probably a 10 lakh crore plus kind of a number by FY28?
Yeah, that's what we are expecting, that we are targeting 10 lakh crore by the year 2030 actually, but it appears to me that we'll be able to reach this 10 lakh crore before by 2029 itself, 28-29 itself, we might achieve this, because renewable energy portfolio is really going forward, because last year we have sanctioned about 1,36,516 crore. That was a jump of 533% as compared to FY23, that was only 21,554 crore. Similarly, coal-based generation capacity, because within 8 years this additional capacity has to come. So therefore, the sanctions and approval will have to be done next 2 to 3 years. For that also, our sanctions loan book for coal-based thermal power plant will also increase.
Got it, sir. And sir, with regard to margins, therefore, you earlier had a guidance band of 3.3 to 3.5%. You've upped that to 3.6 now. You feel comfortable with this number is what you seem to suggest. So tell us, is this something like a medium-term target or guidance, 3.6% margin, and sustainability of that?
Yeah, we have made constant efforts to reduce our cost of funding. Our cost of funding has gone down by 15 BPS from 7.28 to 7.13%. We are making a judicious mix of our borrowing, particularly external commercial borrowing with innovative hedging techniques has helped us to bring down the cost of external commercial borrowing to say at around 6.6, 6.7%. And that's why we are targeting to bring down our cost of funding to say about 7%. And we hope to hold on to this net interest margin of about 3.55 to 3.6%. And our spread is also improving. Last year, our spread has improved by 41 BPS from 2.45% to 2.86%.
And this is despite all the prepayments you've seen in FY24. Do you see that prepayment trend kind of continue into FY25? And you holding on to surplus liquidity, yet you've done this kind of margin. So I want to try and understand whether prepayments are expected to continue. You see that trend continuing, and despite that, margins will hold. So therefore, would you therefore expect some margin upside from here?
Yes, actually, the very nature of renewable energy, you have to see the business actually. The turnaround time of renewable energy projects are very fast. It gets commissioned, solar and wind projects get commissioned for a period of 2 to 3 years. The developers wants to exit and they want to invest their equity in some other project. So there is likelihood of prepayment for this commissioned renewable energy projects actually. But the prepayment which are going to happen, we are going to meet through the large scale volume of sanction that is happening actually. My loan book for the project pipeline for the current financial year, for example, is quite strong actually. For renewable energy projects, I have a pipeline of about 1.75 lakh crore projects are already there. Then conventional generation, transmission and distribution, we have huge pipeline projects. This year we are targeting total sanction of about 4 lakh crore. But since these projects get commissioned over a period of 5 to 6 years, the disbursement will keep happening over a period of 5 to 6 years.
Understood. And sir, just with regard to, I'll try to switch focus here. With regard to net NPAs, you're guided for bringing it down to 0%. I want to understand what is the impact of that on your P&L that one can expect in FY25?
Yeah. Our gross NPA is about 13,800 crore. And those assets which are heading towards liquidation they are about 2,222 crore, for which we have made 100% provisioning. Remaining assets, we are expecting a good resolution, and since we have made provisioning of 70%, we are expecting that we'll get write-backs to the tune of about 30 to 40%. In some cases, it may go up to 50% also. The total write-backs would be say around 1,500 to 2,000 crore. That will add to our P&L account.
Understood. Got it. And this is so you will have a positive number of 1,600 to 2,000, and you'll have a net NPA of 0 at the end of FY25. Is that how your P&L will shape up?
Yes, sir, that's what.
Okay, understood. So a net write back of 1,500 to 2,000 crore is what you're anticipating. Okay, understood. And sir, just with regard to last off, what this does to your profit after tax, maybe not in FY25 because there will be these write-backs and these one-offs, but in terms of overall credit costs as well as profit after tax growth, you've done 13% on your top line over the last 5 years. I've pulled out the numbers, but you've done 20% on your bottom line. That's because of OPEX. Your OPEX has been extremely controlled, extremely muted in terms of its growth. Sure. I want to try and understand at 17% AUM growth all the way to FY28 or FY30 while you're doubling, how will your profit after tax move? Will it be 25%? Is that how the math will work? Because as you scale, that advantage will come to you.
You're rightly analyzed. Actually, our asset under management will grow around 17 to 20% actually over the next 3 to 4 years, and our profit after tax is bound to increase to say about 23, 24, more than 23, 24%.
Understood. And so last off, with regard to dividend yield, you will continue the 30% dividend yield policy regardless, and would you require any extra capital while you are growing, because you're a high cash flow or rather high profit business, and therefore capital adequacy will remain healthy despite you not raising capital, or will you require a capital raise? So dividend and capital raise.
Yeah, our dividends, since we are a government company, we have to follow DIPAM guidelines. So 5% of the net worth or 30% of the profit after tax, whichever is higher, we are bound to give that dividend. That trend will be on the upward swing only. With regard to capital adequacy ratio, because a lot of projects which are approving in distribution segment and that are supported by government guarantees actually. So we'll be able to keep the capital adequacy ratio of more than 25%.
And no capital raise required.
Yeah, no equity infusion would be required.
So no equity dilution either. Okay, thank you so much, sir. It's been a pleasure speaking with you, getting all of that perspective on REC. Extremely interesting play. Super bullish with regard to the way in which this is moving, at least street analysts, and the way they're looking at how REC is shaping up. So many congratulations. Wishing you all the very best for FY25.